Hi, I'm Aoife Devitt, and welcome to today's Markets Happy Hour podcast. It is Thursday, September 25th, and I'm delighted to be joined here by John Normand, Head of Investment Strategy for Australian Super. He's based in London, a frequent commentator on the media and on the conference circuit. Welcome, John. Thanks so much for coming here.
Thank you for the invitation, even.
Well, I've entitled this week's presentation Bottlenecks, Bailouts and Breakthroughs, as clearly there has been, as usual these days, a deluge of geopolitical information. We've heard about bottlenecks on the AI front and the need to open data centers and make some hefty investments in data centers. We know there are bottlenecks on the trade front as well as on the geopolitical front. It seems like a flashback to '08 or '98 with tales of a bailout of Argentina by the US, or at least the promise of some support there. And we are looking at some breakthroughs and some of dislodging some of the logistical issues that we're seeing around back to AI and perhaps on the economy, a breakthrough of growth. Maybe things are better than we seem. So before we kick off, just as a reminder, we do cycle through main topics of inflation, interest rates, equity markets, geopolitics, and other asset classes. And some of the subtopics for today, we'll be looking at a vibe check on the economy and asking whether objects in the mirror are larger than they appear, meaning are things actually slightly better than we are giving them credit for? And in that case, should we pay attention if the US Fed says not so fast on our expectations of interest rate declines? We look outside the US at markets such as China that are also benefiting from AI trends and suggest whether whether it's so exceptional any longer. And then we'll get back to our bottlenecks, bailouts and breakthrough topic, as well as portfolio implications. So here's our special guest, John. He is Head of Investment Strategy at Australian Super, the country's largest superannuation fund and one of the world's largest private pension funds. He focuses on asset allocation across public and private markets and is based in London. So now, after all that introduction, John, a kickoff. So I think one of the themes that I'm seeing this week is a suggestion that the economy, despite we already knowing it has a fairly sort of solid base layer and base case of resilience, is perhaps even better than we think. And some indications of that is that we've just had a revision just today of the US second quarter GDP growth rate being revised up to 3.8% from previously expected 3.3%, and a suggestion that between tariffs generating more income for the US and immigration getting essentially being put under control, that the policies are working and things are going well. Any thoughts from you in terms of that vibe check and whether we perhaps are underestimating the strength, at least of the US economy?
I'd say things are going well for the US economy. I think the only indicator that you would use to say things are going well is either second quarter GDP, the headline number, or maybe the current quarter nowcast on GDP. But when you look below the surface, there's definite slowing that's worrisome, and there are definite imbalances in the economy that, if unsupported by monetary easing over the next few months, I think would catalyze a further slowdown in the U.S. economy. So certainly, if one focuses on just the headline GDP number for Q2, the one that was revised higher, it's very impressive. If you average it with Q1, it's still a pretty solid pace, around 2%. If you look at the tracking indicators for Q3, the economy is printing a bit above 2%. But if you look at the labor market, at least the demand indicators, there's clearly a slowdown. If you look at the housing market, it's clearly in the doldrums. If you look at manufacturing, it's also in a slump. And I think the common thread around all of these is both the level of policy rates, which is slightly restrictive, and the policy uncertainty, which is created by a number of announcements that continue to come out of Washington. So it's certainly not the case that this is an economy on the ropes. It's definitely not an economy that's been knocked off track by all of the policy decisions that have been announced and implemented over the past few months. But there is slowing below the surface, and I think there's the need for a policy response. But also, because that policy response is already in motion, the Fed has already restarted the easing cycle. It is planning and projecting that it will ease more into next year because fiscal policy is being eased slightly as a result of the big, beautiful bill that was passed in July. There are good reasons to think that whatever slowdown follows from here is going to be short-lived, and it's not going to be particularly deep. So I think this is the big reason why risky markets continue to deliver a good amount of strength, is that they recognize that despite what might be going on under the surface, despite these weaknesses in certain sectors, there's a policy dynamic in place which, in the round, is supportive, even though the tariff policies specifically, and even though the immigration policies specifically, are not supportive.
Really interesting analysis. And I suppose just to dig into two of those aspects, tariffs and jobs. Tariffs, we hear about tariff revenue, breaking through expectations. What we hear less about are the kind of the day-to-day impacts, maybe among small and medium businesses dependent on imports, who see their margins now compressed, forced to eat some of the pain themselves. They haven't, because they maybe were in solid, rude financial health and had good cash balances. They have the ability to cushion some of this blow. But I suppose the question would be is, have we seen the full transmission of the tariffs yet? Do you think that we're kind of writing them off as being as having only temporal and maybe temporary impact that we'll see further effect?
I don't think we have seen them all in the way that most economists represent this shock, which is, or let's say, hit to income, which is still to come, is by looking at this gap between the announced tariff rate, which is in the high teens, and the effective tariff rate, which is calculated based on the actual levies divided by imports. And because the amount of tariff that's been collected is below the rate of tariffs that's been announced, people assume that tariff collection will go up with time. It's simply a lagged effect. And as that happens, some of this will be borne by businesses in the form of lower profits and tighter margins. And some of this will be borne by households in the form of price increases that some businesses pass on. If you think of that as a worst case scenario, I actually think that that's a fairly good outcome if the hit to incomes is distributed more or less equally between the corporate sector, which we know is in pretty good health, and the household sector, which is struggling a bit on the income side, but at least has strong balance sheets. Now, the fact that this is all getting spread evenly and the impact is not being felt in terms of a major slowdown, I feel like it's just good luck. I don't think any policymaker looking at this event ex ante in March before Liberation Day would have predicted that the distribution would have been even enough to allow the economy to continue expanding at a near trend pace on average when there's such a big tax rise, which is coming in the form of tariffs. So when people say, how did all this happen? How did the economy manage to move through this? And what are the odds of it continuing to move through this hit going forward? I'd say there's a bit of good luck that just happened to strike. The other bit of good luck is in the form of what's happening on the AI side. The mega cap tech names are just so flush with cash that the tariff policy is kind of immaterial, and so they continue to spend enormous amounts in terms of their own capital expenditure. This is what's keeping business fixed investment in aggregate looking reasonably stable, despite the fact that the spend on structures is down a lot. The spend on equipment is going up, and the spend on IP is going up. Again, no one probably would have thought ex ante in March that this would have been the saving grace of the economy to help smooth through this hit from tariffs, but it's playing out that way. And finally, as I said, you've got a recycling dynamic in terms of fiscal policy, where some of the income which is being taken away from tariffs is being promised to be put back into the economy next year, and all these things, to some extent, were not really forecastable in terms of their magnitude and their timing when Liberation Day hit. But because all of them are kind of going on in the background, this is important context for thinking about why the economy has proven resilient and why it's probably going to remain, reasonably resilient going into 26.
And it's really interesting down on the job side. One of the suggestions I read this week was that we did suggest that the lower job numbers being revised downwards was what precipitated the recent cut by the Fed, only the 25 basis point cut. However, the suggestion is that because of this immigration picture, the dramatic fall off in the availability of labor, that may have contributed to these lower employment numbers, that the employment number may be better than we think. Now, I think there's an equally convincing narrative that the employment number is worse than we think, because some of the high-end roles that are being essentially not filled or replaced by AI, they may not have made their way into the employment numbers, unemployment numbers yet. I know that some of these large tech companies you mentioned, despite having their massive cash investments on the one hand, are also cutting labor on the other. And so perhaps can we read anything and make any sense, do you believe, today of the employment numbers that we're seeing?
I think you can. I feel like the big message in the jobs market in the US, irrespective of the magnitude of the revisions, is that hiring has been slowing across the board in every industry for about a year. And that's an interesting behavioral response from a corporate sector, which is still generating quite decent profits growth. Usually we think of companies as adjusting their labor demand maybe as a last ditch response to a profit squeeze. If they're not really suffering a profit squeeze as measured by S&P profits or NIPA profits, yet they've slowed down their hiring considerably, something's going on. Now, one theory is that they're no longer needing so much labor because they either are experiencing or are anticipating a productivity boost from AI. I feel like it's a bit soon for that. Certainly AI has been diffused very quickly through large corporates that are working in the tech space, but it hasn't been diffused quickly through all sectors of the economy. So I don't think that's the explanation. My guess is there's a certain conservatism in the corporate sector, both because of the moderately restrictive stance of monetary policy and the policy uncertainty which is being generated by Washington. So I think when you look at how few people are being hired in the US in aggregate, despite the fact that corporates are generating pretty decent profits, it makes me think that something's a bit amiss. I mean, nothing catastrophic, nothing that can't be arrested through lower policy rates, but there's to me a sort of implied or revealed conservatism in the corporate sector in the US because of these factors that I mentioned.
It's a really interesting thesis, suggesting that maybe the uncertainty that's prevailing, none of which seems to affect markets, is implicitly affecting markets through affecting executive behavior. And obviously, the natural follow on from the economy being stronger than we think is there would even be less justification for a further rate cut, certainly for a jumbo cut that was maybe forecast this time around. And we've had the caution, I think, being sprinkled by the Fed in the last week around not necessarily nothing being guaranteed, the term modestly restrictive. So keeping the door open, but not necessarily suggesting. Do you have a view as to whether markets got ahead of themselves, thinking that this was the beginning of a downward cycle?
I don't think the markets got that ahead of themselves because remember the market is dealing with two or let's say three phenomena that are some of which are concurrent, some are simultaneous. The concurrent phenomenon is the fact that the Fed does have a dual mandate, and one part of the dual mandate is arguing for lower rates. That's because of the slowdown in the job market. But the other issue, which is a little more sequential, is what will be the reaction function of the Fed when it's run by a different chair as of May of 2026. And I think that's part of the reason why the terminal rate is still around 3%, even though the current Fed chair is saying that policy is not on a preset path. And the current chair is also saying that there are sort of two-sided risks around the dual mandate. So because the market has to not only price what the current Fed chair might steer policy towards in the next few months, kind of the twilight of his chairmanship, versus where policy might go from May forward. I think that's why you get a pretty steep decline in implied money market rates over the next 9 months or so. You can debate what the distribution of those cuts is going to be over the next 9 months, but I don't think that the total amount of easing in the curve through the end of next year is that odd. There are issues around both what's going on in the labor market, how much easing is required to arrest that slowdown in labor demand, and also what's going to be the reaction function when the new Fed chair takes his or her seat in 26.
I love that reference to the twilight because I actually think that because we are in the twilight of Chairman Powell's tenure, it makes some of that discussion around Fed independence get, I think, increasingly moot because, in a sense, there's going to be a change, and in a way, it's already been factored into many of the numbers. Well, just moving on to some of the other dynamics in the economy, we've already mentioned AI being really the saving grace of a sluggish economy in some other aspects, some other sectors. We've seen news this week of OpenAI expanding its Stargate AI project with massive commitments around expenditure into data centers, 400 billion. We're also seeing more of this kind of incestuous cross-fertilization, perhaps, of NVIDIA now investing up to 100 billion in OpenAI. There seems to be a lot of this inter and intra operations and investments between some of the main players. I suppose, given the dollars involved here, especially around investment needed, and we know that OpenAI has massive fundraising needs because to support some of this. Do you think that any of this starts to look like a house of cards in that there's a lot of hype, but there's a lot of money and expenditure needed to sustain that hype?
I don't think it's a house of cards if you measure it by a number of the usual indicators of a CapEx bubble or an asset market bubble. Meaning, I think if you want to say this is house of cards, you'd have to demonstrate that the amount of capital expenditure is extraordinary across all major subsectors of corporate investment, and that it's been running at an extraordinary pace for quite a while, and it's being debt financed, and this is being mirrored by bubble-like valuations in the asset markets. And there are aspects of each of those indicators that I mentioned, which are maybe amber colored, but I wouldn't say any of them are red. So if we just look at CapEx in the US, there was a very sort of lofty pace of CapEx growth for structures in 2022 to 2023, and then that ebbed off and it sort of handed off to equipment spending, which is now running at a pretty healthy clip. And in the last GDP report, we see a perking up of IP spend. But if you look at what happened in the late 1990s, when there was a much greater run up in capital expenditure, the numbers ran at these sort of above average pace for a couple of years, sometimes up to 3 years, and they were running hot across the board, across all the subsectors of CapEx, and the valuations were at record levels, and debt financing was one of the preferred ways of sort of boosting that sort of corporate activity. And debt financing is certainly something which is coming more to the fore in terms of the AI story, particularly through the private credit markets, but it's a pretty recent phenomenon. The nominal amounts, sound large, but they're not large relative to the size of the corporate sector or the size of these companies. So that really straining the quality of the balance sheets. So it's right to be tracking all of these indicators. It would be unusual for an innovation wave to not end in a bubble. But from what I'm looking at, I still think this is a mid-cycle phenomenon and not a late cycle phenomenon.
Fascinating. Well, we'll certainly return to that topic of bubble a little bit later when we speak about private credit. Just other, not getting on to equity markets, we've spoken about some of the record numbers being hit in US mainstream equity markets, and September seems to have bucked the trend that's usual for September by being quite robust. We have seen Goldman Sachs strategists suggesting that we could expect more volatility in October. And I suppose there is an inevitability of some profit taking, certainly. And the fact that the Russell 2000 is now participating in this rally, I think it is a sign of at least breadth emerging, which I've seen other statistics suggesting that despite a very concentrated market, still there's more breadth emerging. And then two other factors, and we've touched on the money market rates, the fact that assets and money market funds continue to rise, are now getting well over 7 trillion, a dramatic increase in the last few years. And then, as you mentioned, money market yields falling. So there is one natural conclusion from those two charts, which is that the more money that is earning less, the more money will seek higher returns, probably in the equity market. So I'd say these are kind of technical factors supporting. Any thoughts in terms of whether the technical factors supporting the market or some of the technicals of the market in terms of concentration and breadth? Does any of that concern you?
So the broadening out of participation, the fact that a growing number of single stocks are rising rather than just being a market which is dominated by a handful of tech stocks, that's generally a sign of health, and it's generally a phenomenon which is associated with the expectation of monetary easing and an improvement in the growth rate of the economy and an improvement in the sources of growth of the economy. All this is kind of standard stuff that happens once every decade or every time following a macro shock or a recession. So everything that's going on in terms of the broadening out of participation in the market is happening as one would expect. That's a good thing. I guess it would be more worrisome if the Fed were easing and the economy were picking up and it were still a market that was dominated by the mega cap names. You'd wonder what was wrong in the plumbing in the rest of the economy, that they weren't benefiting from some improvement in growth prospects and some loosening of liquidity conditions. Now, I guess the problem with the whole story is that even though we are at the very beginning of a restart of the Fed easing cycle, and we're at the beginning of a revival in growth from 2026 on, the valuations are what I think are late cycle-ish, in the sense that credit spreads are near cycle tights, and PEs, at least for the US market, are quite elevated, ex the period of the dot-com boom. And that means there's just less to play for in terms of prospective returns, expected returns, even if the economy does better in 2026. And that's something I think that people have to take into account for their asset allocation. It can be something that determines whether or not they take as much risk going into a 2026 upturn as they would usually do. It's an issue that affects whether or not they take more of their risk in the U.S. versus the non-U.S. markets, whether they take more in the Mag 7 versus the 493, whether they take more risk in the public markets versus the private markets. So there are all kinds of ways you can still believe in more liquidity over the next year, better growth in 26, still have sort of conservative return targets, still have a conservative asset allocation, but maybe tilted a little more towards those markets which are not quite as elevated as the U.S. market and public equities and public credit specifically.
Yeah, it's interesting advice. It certainly is that age-old mantra of diversification. Nothing new, perhaps, in terms of the advice we give to our clients, but increasingly important, especially as we see the weaker dollar. And just show these charts, just how Chinese tech stocks, for example, after languishing post-COVID for some time, really taking off now at stripping their US competitors. AI, clearly a name of the game there. I think perhaps we probably don't know the extent, maybe you do from your vantage point via your Australian counterparts, whether there's a greater vantage, a greater insight into the Chinese tech story. But by all accounts, it does seem to be explosive and now being reflected in stock markets.
But I think this highlights the two-tier nature of the Chinese economy. We often talk about the U.S. economy being two-tier. There's tech and everything else, whether you're looking at capex or looking at market performance. And China has its own sort of two tiers between the tech economy, the newer economy, and the fixed asset economy or the old economy. And it's possible to invest in one and not the other. And the share price performance, which you're showing here, is simply the Chinese analog of what's going on in the U.S.
And moving then to private equity and private credit, and 2 points here really. One is just obviously private equity is supposedly going to be benchmarked against public equity and to some degree, and trying to achieve a premium versus returns there. I thought this was an interesting chart around some of the strain within private equity, simply basically showing the exit of deals and showing the number of realized deals and how there has been a dramatic drop off in deal realization. And I'd say there's probably a bottleneck to be described here in terms of the rush for the exits within private equity. We've also seen quite a lot of but got some titles here such as private equity is getting boring, suggesting that as it gets so large, there has just been a squeezing out of some of the excess return in there. And certainly we have seen some firms struggle to raise assets, given that many investors have simply not been getting their distributions back. I don't know, do you have any comments on this phenomenon, this kind of, I suppose, the getting rather heavy in terms of assets at the private equity firms and just an inability to exit some of their deals?
You're right to refer to it as a bottleneck. There's an inability to sell a high volume of assets from previous vintages where those companies were taken private at high valuations and with leverage, which maybe wasn't appropriate for the rate environment, and it would take a while to work off those deals. But I think it's important to realize that private equity is not generating poor absolute returns despite this overhang. It's just generating very poor relative returns versus its own history and versus the public equity markets. So private equity buyout, at least, is a market that historically has generated maybe 15 or 16% returns per annum versus public equities like MSCI ACWI, global equities, generating maybe 10%. The returns over the past year were something closer to 6 or 7, where the public equity markets were delivering 15 or 16. So that's a role reversal, but it's not a performance which is poor by fixed income standards, and it's definitely not an alternative asset class which was generating negative returns. It's not like investing in property over the past couple of years. So I think it's important to be sort of specific around what the market is delivering versus what some of the headlines suggest. But also in that same spirit, it's also worth realizing that historically there have been different drivers or certain drivers of PE returns which are likely to continue. So there's the drive towards generating an earnings stream, which generally has beaten global equities. And the additional premium has come from re-rating. There won't be re-rating in those markets in an environment of sort of highish interest rates, but the ability to generate the earnings premium over traditional markets, I think is still intact. So the seeds for the recovery are being laid in the same way that lower interest rates promote a broadening out of the earnings stream across many sectors. I think that will benefit private equity. These earlier vintages will be worked off, and at some point over the next year or so, I suspect that the gap between public equity returns and private equity returns is going to narrow further. It'll be because the public equity earning cycle will have matured, because the AI cycle will have matured. The earning cycle of the private equity markets will be picking up because it's a sort of lagged beneficiary of what's going to be happening on the interest rate side. And I think 2 years from now, you'll see that role reversal where the private markets are again generating higher returns than the public markets. And it's important to keep that horizon in mind, that what looks like a very challenging or still challenging situation for these private markets now is probably not going to look that way in a couple of years when rates are lower and the AI cycle is much more mature.
It's really interesting. And just the last point, really, to build on that, because obviously the two are quite intersecting, is a private credit market. We're speaking about hints of a problem, and we talk about, maybe these nagging signs of weakness that we see in the economy. And just this week, we've seen both a subprime auto lender as well as first, then also as a car parts manufacturer, car parts seller, First Brands. So Tricolor in terms of the subprime lender and First Brands both experienced difficulties and seemingly capture JP Morgan and First Third Bank as being kind of wrapped up in those woes. So I suppose some of this, the opacity around some of the private debt issuers seems to be very reminiscent of what we experienced during a peak 08, 09, when there was maybe an abundance of capital chasing deals. Maybe due diligence was not what it should have been. Maybe transparency was not what it should have been. And it does seem that there seems to be some shocking, not outright fraud, but certainly inconsistencies in some of the financials. Do you think that this is the tip of an iceberg that we're going to see, given that private credit market is now over 3 trillion and we haven't really seen a default cycle? Do you think that the sort of signs of trouble like this are canaries in the coal mine?
I don't think so. I tend to look at aggregate numbers more than individual single name issues because it's the aggregate story to me is just more revealing about the overall state of the market. And the aggregate story in private credit or in broadly syndicated loans is, in my mind, a story of low intensity credit stress, meaning there's a level of defaults in these markets, which is up from maybe where they were 12 months ago, but they're not high by historical standards. And that's why the returns have remained in the high single digits despite some of these restructurings and some of the defaults. And if you think about the background conditions that have led to that low intensity stress, it has been resulting from an economy where policy has been restrictive, where the borrowers in these markets are on floating rates, not fixed rates. And the economy has been bifurcated in terms of the earning stream between the mega cap tech companies who don't issue into the space, except very recently for some data centers, and the non-tech economy, which has been a little more struggling in terms of its earnings delivery. So if you think that's been what's been driving the stress, and you also recognize that the Fed is going to be cutting more, and that will benefit disproportionately the floating rate market and the credit quality and the debt service capacity of the floating rate market, which is what the private credit market is. My guess is that the credit risk around this is going to diminish, and that we've likely seen the peak in defaults. The issue to me is more in the asset allocation context. Would your marginal dollar go into private credit or something else at this stage in the cycle? And for me, it would go into something else, mainly because as rates come down in a floating rate product, the all-in yield on this is going to go down. And also as rates go down and the market picks up in 26, you'd want something that gives you a little more leverage to the business cycle. And that suggests equity-like assets, whether it's public equity or private equity, maybe infrastructure too, and not credit, where the return is capped. So I'm pretty neutral on private credit in the sense that I think the defaults have peaked, but in an asset allocation context for the next year, I don't think it will be the best performing market as it had been previously, because the rate cycle is kind of working against the all-in yield. And at the same time, the rate cycle is probably going to support these other alternative asset classes that are a little more leveraged to what the economy and the earnings stream are going to deliver.
Absolutely fascinating. Well, I think we probably don't have time to discuss some of the other to think flashbacks I've had of '08 in terms of the bailouts, etc. But what I think is really fascinating and tantalizing that you set out there is we really haven't, at least I haven't done that kind of forward thinking. Well, what does this easing rate cycle mean for some of the languishing asset classes, such as say infrastructure? And I say languishing, it was obviously very popular. It then that some of the business models didn't make sense with higher rates, so I'd say it perhaps didn't deliver the returns. But looking, of course, at some of those is a beneficiary of the rate cycle will be very interesting. Well, thank you so much, John. This was an extremely detailed, nuanced, and real fresh take that we've had on many of the issues that we've been discussing for months. So thank you for
Thank you
coming
for the
here.
invitation. I enjoyed the conversation.
Yes, and when you do that so well, we'll just have to invite you back. So look forward to hopefully seeing
Very
you
good.
back in a few
I'll
months.
happily do it. Great. Take care.
Thank you.